All right, we're back at 22 minutes after. The FDIC has approved guidelines for private equity firms to buy failed banks. Wilbur Ross, chairman of W.L. Ross & Company, says the potential pool from private equity firms could be $100 billion. He joins us now with his reaction to today's vote. That's what I care about. What do you think?
Well, I think it shows that they did listen, at least in part, to the commentary that people put in. There was something like 59 letters that went in, including endorsement of the private equity position by the American Bankers Association, by the bank regulators from a large variety of the states, and by the Community Bankers Association. So that suggested to me that there was not just a private equity community speaking for itself, but a broader public speaking.
All right, so they listened, but did they go far enough in your view? Because they didn't change all the rules. They lowered the Tier 1, but you know you still have to hold for 3 years.
Right.
And then there's the cross guarantee as well.
Yeah, well, the Tier 1 going down to 10% will cost them money on the bids because we have to tie up some idle capital. It will not be prohibitive in the sense that we just won't be able to bid, which is where we would have been at the 15% level. But interestingly, they did say it wouldn't be retroactive, but they didn't make very clear what that means. We, as you know, at Bank United had a different arrangement with the FDIC.
Right.
So hopefully they will not be putting it in any way retroactive.
You know what we're going to ask you, and that is, Wilbur, have they gone far enough in terms of what they're changing or their proposals here to make you want to go out and buy more distressed bank assets?
Well, I think that if they did away with the retroactivity, then sure. That would be a very big help, because if the government were to be in a position where I make a contract with them the end of May, which is what we did, and then 2 months later they changed the whole rules of the game retroactively, why would you enter into any more dealings with them? So it's very important to me that there'd be good clarity what they mean by not being retroactive.
And forgive me, but I've got to ask you, do you trust it? Because I think some folks would say, well, wait, the government's changed the rules a couple times over the last few months in terms of some of these processes. Are you at all worried that things could change again?
Well, I don't mind if they change things on a prospective basis, because then you know what the rules are at the time when you make the bid, and either you like the rules and you bid, or you don't like the rules and you don't. So the biggest complaint I had was retroactivity. And if they dealt with that truly, then that overcomes the biggest objection that I had. And the 15%, I think, was just off the chart. I agree with the one board member there who said that there's no proof that the 10% even is necessary, the one dissenting vote.
Right.
And I think when they re-review it in 6 months, they probably will find that it has already cost them a huge amount of money, and hopefully they will relax it some more.
What about the cross-guarantee proposal? And that has to do if a company owns more than one bank, that the FDIC can use the assets of a healthier bank to basically cut the losses from one that's failed.
Well, if I understood correctly what Chairman Baer said, because again I haven't seen the text,
right,
that's only applicable if 80% of the ownership of the two banks overlaps. So let's say in the Bank United transaction, it was basically ourselves, Carlyle, Blackstone, and Centerbridge. Right. That was more or less 80% of the whole deal. So if I understand it correctly, as long as it weren't that same group overlapping in the new one, then the cross guarantee would not apply.
30 seconds before we have to take a break. Net, do you go home and celebrate?
No, I don't go home and celebrate, but because I really do want to read the exact language. Very, very often in government things, the devil is in the details. And what wasn't at all clear was whether there were new provisions that were added. They talked about the ones that they changed and didn't change. I don't know what else might have been added, but on the face of it, it's far better than the proposal that they had before, but it's not a champagne cork popper.
All right, sit tight. We're going to take a break and come back and talk some more. We are talking with Wilbur Ross. Stick around. All right, welcome Welcome back, everybody. We continue our discussion with Wilbur Ross, chairman of WL Ross & Company. So, Wilbur, I know you want to look closer into really, as you said, the devil's in the details in terms of what the FDIC is proposing here or planning to do here. But do you have a lot of banks you've looked at closely, you're just maybe waiting to sign on the dotted line?
Well, we aren't that far along, no.
You're not that far along?
No, and neither could anybody be, because to do due diligence on a bank with all the problems that exist nowadays, you have to be allowed inside. And they generally only allow you inside very shortly before the time when you bid. So we have a pretty good list of who we'd like to get inside and who we think will fail. But now that they've cleared the air, I think that it'll be a lot easier to at least get inside and do the due diligence. To the best of my knowledge, they have not been letting private equity in to do anything during this interregnum period, and that's fine.
You mentioned this list. How long is that list?
Oh, it's quite long.
Quite long,
yeah.
And I'm assuming it's diverse.
Well, I think that there are probably going to be 500 banks failed between now and the end of 2010, and maybe 10% of those are ones that one would want to look at. So it's quite a large universe. So
safe to say that there's at least roughly 50 banks that you guys are looking at?
No, that we would like to look at.
Okay.
That we'd like to look at.
Okay, but once you go through the details, and again, I know it's really tough since you haven't gone through it, could we assume that you would potentially you'd be doing some more deals here?
Oh, well, we will bid some more, assuming that it's the way that I, understood it over the video conference.
Right.
We'll bid. The problem is we're not going to be able to bid as much as we would have before. In the case of Bank United, our bid, if these had been the rules, probably would have been a couple of $100 million lower.
Okay. All right.
So that would have been another couple of $100 million lost forever by the FDIC.
How much private equity money is out there potentially to go after banks?
Private equity altogether has around $400 billion of unused equity funding. I don't think all of that would go into banks, but conceivably $100 billion could.
Okay, so a big chunk of it.
Sure.
Hey, listen, there's one criticism that's come out in terms of private equity is that they don't really have the size. It's coming from some of the large banks. They don't have the size, they don't have the capital or the synergies of a bank to really do it or to make it sense. What do you say to that criticism?
Well, first of all, we've owned banks before. I bought a failed bank from the Japanese government. We fixed it up. We eventually merged it at a very good profit into Sumitomo Mitsui's Kansai Bank. Other private equity firms have done the same thing in various jurisdictions. So first of all, it's a fiction that private equity has not dealt with banks before. We have. And to the best of my knowledge, no bank that was a failed bank bought by private equity has ever failed back. So it isn't like there's a body of problems out there that provokes this. And there's no bank that ever failed because of the nature of the investor. They've failed because they didn't have proper management, didn't have proper supervision, but the name tag of the investor isn't what makes a bank fail.
Let me ask you, in terms of we've had so many bank failures already, do you see it necessary, a crucial component for private equity to have a play in being able to pick up some of these distressed banks to help kind of ease the financial crisis, maybe the last leg, if you will, of kind of getting out of it?
Well, I don't see how it's logical to think that banks who have TARP money from the government, meaning that they basically failed, and all the big banks, most of the big banks have TARP money, how you can call them a source of strength when the only reason they even exist is that the government had to put more money in. To me, it's ludicrous to say that that's a bigger source of strength than a private equity fund. No private equity fund has ever taken any TARP money.
I want to ask you about something you guys recently did. You brought in Jim Lockhart, formerly of the Fed Housing Finance Agency, oversaw Fannie and Freddie. I'm just curious how that appointment, if you will, bringing him in kind of plays into your strategy here.
Well, we've made no bones that we intend to build up more and more investments in financial services. And so Jim obviously knows a tremendous amount about the mortgage business from the activity he's just had. But before that, he was a managing director at Smith Barney. He was co-head of their private finance group. He also had been treasurer at Alexander & Alexander, a big insurance brokerage firm. So he has a lot of skill sets and a lot of relationships that we think will be very useful to us.
All right, so specifically really shaping what you guys do going forward.
Yeah.
Let me also ask you about some of the other industries that you guys have played in terms of coal and steel. I know you look at a lot of distressed areas. What are you seeing in terms of opportunities in those environments?
Well, we just recently made an investment in Greenbrier, a company that manufactures rail cars and barges and leases them. And we're very, very happy with that. It's actually worked out, excuse me, very well even in its early days. But the reason we're in there, that industry has been very depressed because with the bad economy, a lot of rail cars are idle. But railroads, believe it or not, are green. The reason they're green is you use only 1/4 as much fuel per ton mile of rail freight as you do with trucks.
All right.
So I think railroad is one of the keys to the future.
We'll be back in 2. All right, back at 38 minutes after, talking with Wilbur Ross, chairman of W.L. Ross & Company. Wilbur and I were talking in the break, and I asked him if there was anything else in terms of the FDIC decision. And I do want to go back to it, because you said it was interesting that it was a split vote.
Yes, it was a 4-to-1 vote. And the dissenter is the man who runs the OTS, the Office of Thrift Supervision, which regulates all the thrift institutions in the country. And he made I thought, a very interesting argument that there's no evidence that's been produced in any of the discussions at FDIC showing the need for any special rules on private equity. And I think that's a very, very interesting and telling comment. First of all, I agree with it. There's never been a bank that private equity bought from the government that turned around and failed. So there is no basis for it. It's clearly just a little bit fear of the unknown. But what I don't understand is why a regulator would think that a bank with only 5% equity, which is what a well-capitalized big bank is, and who had to take TARP money to stay alive, why that's a better source of strength than a private equity firm totally escapes me.
All right, but 10% you're okay with?
Not okay with it. I think it's within the range where we can at least still bid, but the bids will be lower than they would have been at what I was proposing, which was 7.5.
All right, as you go through more of the details in terms of what we got from the FDIC today, potentially tomorrow, could you be more active and start moving on things?
Well, we have our hit list, and as those come up, we would intend to go forward. But the interesting question will be, now that the banks with whom we would be competing, you know, it's a competitive auction is the way you buy a bank. Be interesting to see, do the big banks now drop their bids too, knowing that we're going to have to bid less? And if so, then that's going to be a very interesting outcome for this rule. And I think there's a very high probability that that'll happen, because the big banks can add and subtract. They'll figure out what it means to our bid, and I'll bet a nickel that they're going to start bidding less.
All right, that's what you're expecting. In terms of the financial crisis, and we've certainly come very far, and this is another step towards kind of working our way towards the end of it. I mean, where do you think we are in this cycle? Well,
we have one big round that we have to go through next, and that's the problem of commercial real estate. There's $3.5 trillion of commercial mortgages outstanding. The first big batch comes due in 2010, because a lot of them were written on a 5-year basis starting in 2005. Every year from 2010, 11, 12, 13, there are $300 to $400 billion of difficult to roll over commercial mortgages coming forward. And where they're a problem, not only were they underwritten on a very generous basis, but now the rent rolls are down, the vacancies are up, the capitalization rates that tell you what the property is worth have changed. So most of these are underwater.
All right, we're going to actually be talking to Harrison Lafrax, so we'll get an idea in terms of what he's saying.
This is a good segue to Harry.
And he's very worried. He's got some big concerns. Wilbur, as always, it's good to get time with you.
Good to see you.
Be well. Wilbur Ross, everybody.